Good afternoon. Good afternoon. It's Monday, the 5th of January. Welcome to another edition of Monday Market Picks. A brand new year. A very happy new year. May this be a very prosperous new year for everyone. And the year is off to an exciting start, as we saw this weekend with the US extraction of the Venezuelan president. Markets are actually taking it in pretty good stride. Generally, SGX is in the green. And if you think back to 2025, the Singapore market was actually up 23%. So can this momentum continue into 2026? That's what we're going to be talking about today. The Singapore economy also recorded some very, very strong numbers and closed very strongly for the fourth quarter. We got our economist, Brian Lee, who is here to explain to us what went down and how we should be thinking about 2026. We'll also look at and reflect on 2025 and what the markets actually told us. What were some of the key themes? And then we'll dive down into some of the key picks from those themes as we go into 2026. Plus, we've just had a big upgrade on Sea Limited by Hussaini, and he's here to explain why. Plus, we got some fresh trading buy ideas from our chart guy as well. So a lot to go through. So thank you so much for joining us today. And let's dive in. Let's start with Brian. Brian, welcome to the show. Now, Singapore's fourth quarter GDP accelerated to a 5-quarter high. Can you give us some context on what is driving this? And was this actually expected?
Yeah, hi Thilan. So what was driving this? Almost entirely manufacturing. We saw manufacturing growth surging to a 4-year high of 15% in the fourth quarter, and this is triple that of the growth rate in the third quarter. And we have two sectors which are driving this, which is the first would be electronics, and that's a function of the AI boom. The AI boom has really boosted orders for electronics exports and chips, servers, server-related products. And then the other driver would be the biomedical sector, and I suspect that pharmaceutical manufacturers are front-loading their shipments overseas in anticipation of any threatened tariffs by Trump in the new year.
Okay. And when you think about all that's happened so far, what do you think MAS's policy direction will be, especially in their January meeting?
Well, I think MAS will be monitoring inflation for one. And look at inflation, it has been rising, but at a gradual pace. In November, core inflation was 1.2%, which is unchanged from October. And I think the core inflation outlook for this year still seems rather benign and within MAS's comfort zone, less than 2%. And if you look at the economic outlook, well, we know that Singapore's growth came in much better than expected last year. But at the same time, this year, we have a resilient economic outlook. And I think on balance with a resilient economic outlook and also inflation still within MAS's comfort zone, I think MAS can have the confidence to basically maintain current policy settings and stand pat in January. So in other words, maintaining a modest appreciation bias of 0.5% per annum for the near term.
Got it. I mean, I want to dig a little bit deeper on inflation a little bit later on. But I mean, let's, take a much broader view of 2026 as a whole. As you said, I mean, I think 2025 closed at a very, very strong position for Singapore. What are your expectations for growth for this year? Is it going to be another very strong year?
Well, we expect GDP growth this year to come in at 2.8%. That's obviously lower than the exceptional pace of 4.8% that we saw last year. But if you look at 2.8%, it's not a bad figure at all. It's still above Singapore's historical trend, which tends to be in the low twos. And it's at the upper end of MTI's 1 to 3% forecast range. Well, we saw very robust growth momentum in the last half or the second half of 2025, and we think that it looks poised to carry forward into the first half of 2026, overcoming any trade and geopolitical shocks. We see three main growth drivers. that could fuel economic growth. The first would be low and still falling interest rates, and also MAS's Equity Market Development Program, which will support the capital market, support lending, wealth management, and also real estate activities. The benchmark 3-month SORA interest rate is expected to slide from 1.2% by end 2025 to 0.7% by the end of this year on continued safe haven inflows. As Singapore retains its appeal as a stable and safe destination, and also on continued Fed rate cuts. The second big driver of growth we see is obviously the AI boom, which everyone has been talking about. We think that the AI boom will continue in 2026 with the major top 6 US hyperscalers expected to boost their capex spending by 36% from 2025. And this should support Asian exports, especially electronics exports. I mentioned just now chips, servers, server-related products. And Singapore is a big electronic exporter. It's also going to support investments, whether it is in data centers, whether it's in R&D services, and also it's going to support our tech services sector as well. In fact, Singapore's role in the AI supply chain is expected to deepen with new Micron and UMC facilities being set up this year. And the third and final theme is the construction boom. We have been talking about it for a while right now, but we think it's an ongoing story with the major pipeline of infrastructure and also housing projects. So we think that construction will continue to be a driver of growth in 2026, Dylan.
Okay, so we have 3 major drivers driving the economy going into 2026. Now, I want to kind of, bring in inflation here. If you've got all these drivers driving the economy, and inflation has been relatively benign in 2025, how do you think that's going to play out into 2026? Do you think there'll be a little bit more of inflation heating up?
Yeah, so inflation in 2025 was benign because of a few things. Disinflation from falling energy prices, travel-related costs, and also sizable healthcare subsidies. This year, since you already have the low base effects in place, that's gonna taper off. So we're gonna have less disinflation coming from these drivers that I've just mentioned. So overall, we are expecting core inflation averaging 1.3% in 2026. That would still be an increase from 0.5% in 2025, but in the whole scheme of things, 1.3% is not high. Headline inflation, we're expecting it to average 1.4% as compared to 0.8% in 2025. And also, I think what we have to bear in mind as well is that on the supply side, certain administrative prices are going to increase in 2026. So this includes 5% hike in public transport fares from end 2025, the new sustainable fuel levy on flight tickets, and also higher carbon tax, which will increase from $25 per ton to $45 per ton, which will obviously affect our electricity bills. On the demand side, given that the economy is still rather resilient and buoyant, we think that consumer spending should be quite solid, and that could result in a little bit more price pressures. But nonetheless, I think in the whole scheme of things, even though we expect inflation to increase, we expect it to be capped by benign commodity prices, owing to slower global growth and also a more subdued Chinese economic recovery.
Got it. But now, if you think about what happened this weekend with, the US going and extracting the Venezuelan president, these are, massive, uncertain events. How should we think about risks going into 2026? What are some of the key risks that you're worried about for Singapore and your growth targets?
Yeah. As you said, Dylan, definitely there have been some geopolitical shocks and uncertainties lately. And that would be one risk to bear in mind, because any geopolitical shocks could, for instance, have an impact on trade. It could also have an impact on inflation. If, let's say, like broader Middle Eastern war or any tensions with regards to US and China or China and Taiwan, that could actually lead to a spike in commodity prices. That is possible, and that could affect the cost of living outlook and also the trade outlook for Singapore. And also, I think another thing to watch would be the US-China trade truce. It's supposed to last until November, but these days the relationship has become more unpredictable. And if the US-China trade truce suddenly gets broken, there could be fresh tariffs on each other, and that could be another disruptor of regional trade. The other thing we need to watch also is tariffs on semiconductors and pharmaceuticals. So far, Trump has indicated that MNCs that are investing in the US will be exempt from these tariffs. But if, let's say, he changes his mind, and then that will be important for us, because our semiconductor and pharmaceuticals sectors make up a very large part of our manufacturing sector. And I think finally, one domestic risk is that on the prices front and on the property front. So on the prices front, as I mentioned earlier, if inflation surprises on the upside, then there could be a chance that MAS could even decide to tighten monetary policy in the second half. And on the property front, if property prices continue to run too hot, or if housing debt rises excessively, there is a chance that the government could introduce property cooling measures still.
Got it. So a lot to watch out for, but at the same time, I think Singapore is off to a great start with some very strong macroeconomic numbers and some very strong macroeconomic expectations. Thanks, Brian, for unpacking all that. Now, a strong macro is a good base for the markets. And as I said, the STI was up 23% last year. Trading volumes are up about 50% as we close 2025. So I think we are in a good position. So I think it's probably the right time to kind of reflect back on some of the lessons that were learned and what we can carry through to 2026. 2025 was a year of extreme global uncertainty, and Singapore traded at a premium for the certainty it provided. Now, this is reflected on the index performance, and it was underpinned by the improvements in ROE visibility and credibility in terms of policy delivery. We also saw AI moving decisively into the mainstream, with banks and healthcare scaling real use cases that are already increasing productivity in these sectors and margins as well, despite actually seeing headcounts in these sectors coming down. We also saw pretty constructive policy-led earnings upgrades as equity market reforms, fiscal stimulus, infrastructure spending, and transport prioritization set up multi-year tailwinds for sectors like the consumer sector, REITs, the small and mid caps, as well as some of the transport names as well. One clear area of divergence, though, was within tech manufacturing. Despite all this hype around AI and excitement around AI, that alone was not sufficient to offset the oversupply situation and the inventory overhangs in some of the non-AI semiconductor sectors. Now, that's actually going to, we think that pressure will most likely persist all the way till the second half of 2026. We also observed improving competitive rationality across internet platforms as well as telcos, and that disciplined pricing and also some of the early consolidation that we saw in the telcos should enable for better EBITDA visibility as well as margins. And we are also pretty encouraged last year from some of the capital recycling that we saw with the REITs. There was M&A to right-size their portfolios, as well as increasing distributions and positioning the sector to benefit from falling rates as well. So overall, we've anchored a positive outlook for Singapore around domestic market certainty, AI-driven efficiency gains, supportive policy, and rational competition. So in terms of some of the cyclical names like tech manufacturing, we remain a little bit more cautious. Now, in terms of stock picks, we like quality beneficiaries of these themes. So CICT, Comfort Delgro, CSC Global, Grab, Mapletree Logistics Trust, OCBC, SGX, Shencheong, and Singtel are some of the core exposures as we head into 2026? As the year flows, we will be re-looking at some of our target prices. But I think in general, we are looking at upside risks to all these stocks as well. So do have a look at our note in the newsletter today for a much more detailed outlook. With that, let's move on to Husseini. And Husseini, you've done a big upgrade on C to a buy. Now, the stock has actually corrected 36% from its peak in 2025. Can you remind us what were some of the concerns that was actually driving this derating of the stock in the first place?
Yeah, sure. Thanks, Alan, for having me, and Happy New Year, everyone. So let me take a step back and we'll go through like why we downgraded the stock in the first place, and also the reason why the stock has corrected is that after second quarter results, everything was looking very good for C Limited. The company had upgraded its guidance, and all the three businesses, which is e-commerce, fintech, and the gaming business, they all were posting very strong results ahead of expectations. So everything was looking very on the right track. But sometime around October, management came out and kind of indicated that the forward-looking margins improvement will be slower. Okay. And that raised the concerns on that if everything is going right, why there will be a margins pressure. And that led to some lack of clarity, and that's the point we downgraded the stock. We are of the view that let's take a pause because there are some uncertainty on the margins outlook, and because of that lack of certainty, the stock corrected around 36% from its peak. One other reason for the pressure was also because of competition in Taiwan and Brazil. These two markets brings in around 25% of Shopee's GMV. And in Brazil, because Meli, which is Mercado Libre, which is the largest operator player, as well as Amazon, they both had kind of raised competitive intensity. Both are deep-pocketed players. So concerns were raised that in Brazil, where Shopee was doing so well, and now as the other players are raising competition, their growth is likely to slow down. So that was one concern. The other concern was in Taiwan, where Coupang had entered as a new player. Coupang is a very well established Korean player, and they had been investing quite a lot in Taiwan. So there were concerns that Shopee, which had been the dominant player in Taiwan, they will face some pressure. So those were two of the competitive pressures. Around 25% of their GMV comes from these two markets. So that was on the operational side. But otherwise, because of the management's indication that the margins will be under pressure because they are investing too much on the VIP program, which is a Amazon Prime kind of a subscription program in ASEAN. They are investing into logistics and fulfillment. So that led to some indication that the margins won't improve as much as we had been expecting, leading to 36% share price correction.
Got it. But what has changed now for the buy call?
Yeah. So, see, first of all, the stock has corrected, and in our view, it is in a very attractive territory. So, 36% correction relative to the kind of risk the company is facing. In our view, the risk reward are much more favorable in favor of the stock. That's point number one. And then the second is that, in 3-4 months, what we had seen is that in ASEAN, they are investing into the right areas. Okay, so this VIP program investments in our we estimate that right now they are losing around $2 per subscriber per month, which is likely to go down to around $1. And in total, that will have a 0.1%, 10 basis point margins impact on the Shopee's GMV. And the other area of investments is logistics and fulfillment, which in our view is unlikely to weigh on margins because they had already been investing. Okay, so that gives us confidence that the investments are relatively capped. As far as outside of ASEAN is concerned, which is Brazil, yes, we do see that there are pressures. In our bear case assumption, we expect around 20 basis point impact on margins. So in total, around 30 basis point, 10 basis point in ASEAN, 20 basis point in Brazil. Now, if we see the street estimates, uh, it has already been factored in. Okay, so it is already priced in. But there are other catalysts as well, like uh, Lazada, which is a competitor in ASEAN. They are getting more and more marginalized, and if the pace of decline of Lazada continues, then by end of 2026, we expect their share will just go down to around 2% of GMV, ASEAN GMV. So as Lazada becomes more and more marginalized, ASEAN will be a two-player market, which is Shopee and TikTok Shop. And Shopee will be the dominant with almost 70% shelf-based e-commerce. So those are the catalysts. There is one more catalyst. Key catalyst is that what company is trying to do is company is sacrificing a little bit of margins for a bigger growth. Okay, and that in turn, and as the market becomes a two-player market, we expect to see a bigger monetization by 2027. And in the meantime, companies fintech business, which is money, uh, that also is emerging as a monetization engine, because as GMV grows on the Shopee side, they monetize on the digital financial services side through buy now, pay later. So those are the monetization angles as well. So taking all this into consideration, we have upgraded the stock to buy.
Got it. So good risk reward at this stage. Do have a look at Husseini's detailed note in our newsletter today. Thanks, Husseini. We got two trading buy ideas from our chart guy today. The first is Food Empire. He thinks that the current pullback is temporary and the signaling for a bullish sentiment remains. So do have a look at that chart today. We also have a trading buy on FRENCKEN Group. The previous downtrend for that stock has ended, and our chart guy thinks that the recent uptick in trading volume in RSI sets this stock up for a new uptrend as well. So quite a bit of charts there to go through as well. They're short of time, so I just want to highlight a very important event that's coming out on the 31st of January. It's our market outlook and feng shui event. As you know, we will have Master Ken as well as our economist Hak Bin Shua and myself talking about the markets. Don't miss out on this. Seats are limited, so do register as soon as you can. That's on the 31st of January. With that, we are out of time. Thank you so much for joining us for our first show of 2026. We wish you a very profitable trading year ahead, and please join us next week. Thank you.